let's say you spent $10,000. Do you get to count your full $10,000 all in that year that you spent the money? Well, the answer is maybe or maybe not. And that's where depreciation comes in. We're talking about rental property. You may or may not be able to deduct the full expense if it goes negative based on if you materially participated or not. You have to count depreciation whether you truly count it or not in the eyes of the IRS. This is why, because even if you don't count it, which is a benefit to you, you recapture it back, benefit to the IRS, because what it does is it increases your capital gain or reduces your basis in that sense. Make sure you got a good accountant, make sure you have a good advisor, make sure you're getting good sound advice in whatever it is that you're doing, and make sure that you're understanding how to count this depreciation.
Welcome to another edition of the Financial Puzzle Playbook with your host, Jim Sumpter. I'm R.J. Malik, producer of this podcast, and of course, we are going to continue talking about the 6 puzzle pieces. And Jim, how you doing?
I'm doing great, RJ. Thank you.
Let's get into what we're going to be discussing on this podcast with this piece of the puzzle.
So, RJ, just like the last episode, we touched on income tax. We're going to continue on with this income tax theme. What we're gonna talk about today is, we discussed business and business versus hobby in the last episode, and being able to talk about, what expenses could count. One of the biggest expenses that you sometimes have in business, especially when you own things or items that do things in your business, is depreciation. And so today we're going to focus on depreciation. I want to take one step back. We mentioned in the last episode that a business is an activity in which the objective is to make a profit. A hobby is an activity that is not engaged for profit. There is a big difference between the two, and is, can you deduct the expenses? And I also mentioned, I don't talk a lot about tax code, but this falls under that rule one, or that tax code section 162. And then we're going to touch on today the depreciation aspect of expensing. So, what is depreciation? Well, anytime you buy a thing or an item for your business that you use in your business. And, we've talked about, in your business, you have all this audio equipment. So
Right.
You have the microphones, you
Headphones.
have the headphones, you have the computer software, you have the computer hardware, you have all these things that you buy for your business. You had to build out this studio, because I believe you're in your home, if I remember correctly.
That is correct,
and
yes.
Most homes aren't set up exactly the way you're sitting.
No.
So you have these expenses. Well, so the question is, do you write them all off in 1 year, or do you depreciate them over time? And so what depreciation is you're recapturing back your money that you spent. So let's say you spent $10,000 on something, and we're going to get into some specifics, but let's say you spent $10,000. Do you get to count your full $10,000 all in that year that you spent the money? Well, the answer is maybe or maybe not. And that's where depreciation comes in. So it's the recapturing back of that $10,000, okay, because it was an expense. So I'll give you a couple of very general rules of thumb. And as most things in tax code, there is a general rule, and then there are a plethora of exceptions.
Okay.
And so just so you know, depreciation rules are no different in the way that it works. But in general, a capital expense is an item that has a useful life of greater than 1 year. Okay. So if you buy a microphone or a headphone or a computer, all of those you would expect to be greater than 1 year useful life. Okay. You could use it into 2026, into 2027, to 2028, and so on and so forth. Well, everything that is a capital expense under the tax code has, because IRS knows everything,
Yes.
they have set up a set of rules that says what is the useful life of these items. So I'm going to take a step back of something that I hear a lot in my business and my practice, and that's we're going to go buy a rental house. So we're going to go buy a rental house, and the house itself sits on a piece of property. So this is not a condo, this is an actual house, okay? So we're going to go buy the house for $400,000, but the tax assessor says the property that it is sitting on is worth 50,000 of that 400, okay? So I go buy the house and I want to get my $400,000 back because that was an expense. How do I do that? And I do that through depreciation. Okay. So rental property, I go buy the 400,000. Rental property, I have to break out the property and the building, because property, there is no depreciation. So the 50,000, we don't depreciate that at all. The building, we do. So the depreciation on the building, so the 350,000, 27 and a half years. That is the general rule for real estate. Now, I will tell you this. If you own a property with the intent of Airbnb, VRBO, a short-term rental or a medium-term rental or a bed and breakfast, those could be a different set of rules. Whole separate podcast we can talk about Airbnb. In fact, that's probably a good idea that we do that at some point.
Yes.
That's not the intent for today. The intent for today, general rule, rental property, 27 and a half years. Okay. So we buy the property, we're depreciating it, and so we need to go and we need to repair a roof. Okay. Now, a roof is a part of the actual home. It's affixed to the home. And I will tell you, in the broad general scheme of things between CPAs, accountants, financial planners, this is one of those areas where it's a little bit gray. And so my general rule is the roof is attached to the property. The roof is 27 and a half years. Some people will argue that it can be less. I am not one of those. I believe that it's attached to the home. It's going to be affixed to the home. And so 27 and a half years. But if I have to replace an air conditioner, I put in new carpet, a hot water heater, new cabinets, things like that, that's 5-year property, because those are not affixed to the property per se. I can still have the property without those things. I'm adding those things to the property, and those are over 5 years. What if I have to do concrete work? What if I have a road that I own that goes up to the property? That's 15-year property. What about, windows, a deck? Again, I would argue those are affixed. Those are 27 and a half. Okay. What if I go in and I have to repaint? Well, that's actually a routine maintenance. That's not a depreciable item, because that is not something that I've got to spend today with the expectation. Now, I hope it lasts more than a year, but what if every time that 1-year lease renews, I go in and repaint? Then it's not greater than a year. So that's really not a capital expense. That's a routine maintenance expense. Okay.
Would siding be the same thing as painting?
I would argue probably no.
Okay.
I think siding would be affixed. Siding would be kind of like a roof or a deck, because it's going to be affixed. Now, if it's the shed, if it's the she shed outside where the lawnmower and all the yard equipment and all that kind of stuff is done, that's not affixed to the house. That would be a shorter lifespan, probably 5 or 7 year. I'd have to look up exactly, but a 5 or 7 year property. So here's the whole point in all of this. Okay. If you have a rental property that you're taking in income, okay, you've got some routine expenses. You're paying a maintenance company. You're paying to have it painted. You're paying the plumber to come do a repair, an electrician to come do a repair. You have to pay the pest control. You have to pay the property taxes, things like that. At the end of the day, you take your income that comes in minus your expenses, then you get to subtract depreciation. Depreciation is an expense, and in many cases, those depreciation numbers can cause you to go negative on the actual profit. Okay, so here's the other key to this, and this is sort of another whole podcast, but we're talking about rental property. You may or may not be able to deduct the full expense if it goes negative based on if you materially participated or not. I have a video on my website that literally discusses this very thing about material participation
Okay.
when it relates to rental property. And it also depends on your income and various other things. But, just know that depreciation is an expense. You may or may not get to take it all in the 1 year. If you don't get to take it 1 year, you can carry it to the next. But it is real expenses and it is real depreciation. Now, here's where I see people, sometimes this happens. And I had a client a couple of years ago. She came to me. She had originally purchased her home to live in it. Then she got married, so she decided to rent her home and move in with her spouse. So now she has this rental property. She talked to her quote unquote accountant, and the accountant said, well, if you're ever going to sell it, you don't really want to depreciate because you're going to have to recapture. Now, I'm going to talk about recapture in a minute, but here's the thing. Depreciation counts whether you count it or not. In the eyes of the IRS, this whole recapture concept is really, really, really important. And so in her case, we had to go back and fix the depreciation because the way the rule works, if you put it on the tax return for 1 year and then you go to the next year and you put it on the tax return, you can go in and do an amendment. But if you go to that third year, you've now created a pattern for the way you're going to depreciate, and the only way to fix it is a separate IRS form. Accountants charge a lot of money to fix it, and it can be fixed, but it's not the easiest thing in the world to do. But the key is you have to depreciate if it's a capital expense and if you have it for income in a business or rental property or something like that.
Hi everyone, I'm Cassidy, the second C in CMC Financial. So Dad sometimes gets on a roll with this podcast and might forget to remind you about a few things. 1, don't forget to like and share this podcast and leave a review. 2, follow CMC Financial on all of the socials, Facebook, Instagram, and LinkedIn. And 3, go check out the website at cmcfp.com. Okay, back to my dad. He's probably still talking.
If you have it and you're renting it out for in our case several years ago, it was in a resort area. Mm-hmm. So we had a finite period of when we could rent it, and it was weekly. It was not monthly or yearly. It was weekly. Mm-hmm. Does that change how we can depreciate it? And
so what you're saying is the average stay was a week or less.
It was 1 week. It was always 1 week. It was not less. It was always 1 week.
Always 1 week. Okay. Yeah. Yes. Remember when I said the Airbnb rules could, if it's a short-term rental, if a stay is 7 days or less, that's considered a short-term rental.
Okay.
From a depreciation standpoint, that 27.5 could go to 39. Where that's important is if you own multiple properties, because you could take a loss on one, recapture that, and shift that to another.
Interesting.
And so the general rule is 27.5, but you could make an argument for 39. 39 is also for commercial property.
Okay.
So if you own a business and you own the building that business leases back, the depreciation on that property is 39 years, not 27.5. 27 is personal rental real estate. And so, I kind of like RJ, a lot of my points on a lot of the podcasts is, I'm trying to scratch the surface as a 30,000 foot view.
Right.
But when you really start getting into this, it's very technical. I have a client that I literally spoke with yesterday, and they sold their primary home, or they didn't sell their primary home, they bought a new primary home. They're going to put their primary home on Airbnb. The question was, we want to leave our furniture that's in it, and we're going to buy new furniture for our new house. Okay, well, what's the fair market value of the furniture you're leaving? That's now the value that you now get to depreciate that furniture. Well, that furniture is not 27.5-year property. It's 5-year property. It's used more than 50% in the business, but it's not new. It's considered used property. So then that's another set of
Wow.
fact pattern that could change things. So, when I talk about tax planning, I'm looking at all of these different pieces of this puzzle. A lot of time I try to keep it simple and talk about the puzzle, but the puzzle literally, I mean, this is what happens. And here's the thing. Let's say you own 3 different properties and you do this for one, you do that for another, and then you do something else for the third. That's perfectly allowed. There's also a concept out there, and boy, I'm really getting in where I didn't want to go, but there's a concept out there called segregation. Segregation says, I want to take the whole property. Let's say you own a duplex. Okay, so now I own 2 properties.
Yeah.
But the duplex also has a garage. And so you can go in and start segregating out and say, well, this part of the property is 27.5-year, but these parts of the property, the refrigerator, the appliances, the cabinets, the carpet, that's 5-year property. So that's a separate item. So you could have one property with 20 or 30 different items on the depreciation schedule that it could make a lot of sense if you own multiple pieces. If you only own one, it really doesn't make sense to go through the expense of doing that.
Right.
But if you're truly going to be a real estate investor, then it absolutely could make some sense to go in and do these things. Let me talk about recapture just a minute. Prior to this episode, you and I were talking about when you and your wife owned this rental property. And then for a myriad of reasons, you decided to sell it. Okay. Well, you didn't own it for 27.5 years.
Right.
So what you had to do when you sold it, and I'm going to use easy math. I have no idea what you paid for it, no idea what you sold it for. I'm going to use easy math. Okay. I'm going to say you bought it for $300,000 and you sold it for $400,000 and you had depreciated $20,000. Okay, so follow my math. You bought it for $300,000, but you had depreciated $20,000. So now your cost basis is $280,000. Okay. Then you sold it for $400,000. What was your capital gain? Well, your capital gain is what you sold it for minus what you bought it for minus unused depreciation you had to recapture back into there because you haven't used that yet. Okay. So your capital gain is more than 100 in my example because of the recapture.
Sure.
Because you had gotten to use it for the first 2 years, but you didn't own it the whole time, you had to recapture back some of that depreciation. And that's where a lot of people don't realize. And that's when I went back to the rule and I said, you have to count depreciation, whether you truly count it or not, in the eyes of the IRS. This is why, because even if you don't count it, which is a benefit to you, you recapture it back, benefit to the IRS, because what it does is it increases your capital gain or reduces your basis in that sense. That's what truly and actually happens. I'll give you another example. A lot of people, they say, well, I'm going to go buy a car and I'm going to use it in my business. Okay. They do that. They write it off they write off the full value of the car, which is 5-year property, but they only own it for 3 years. Well, what about the other 2 years? You're recapturing that back in, even though a car is a depreciating item most of the time. It could be by the time you recapture that depreciation, you could actually wind up with a gain on your automobile, but you didn't realize it because you tried to expense too much of it.
Got it.
All right. So I'm going to jump into a couple of other caveats in here where we talk about rental property, not depreciating it, going back and fixing it. We talked about this concept on the surface of recapturing. Let's go back to the car example. Okay.
Mm-hmm.
There's a concept that came into play in the tax law or the tax code in 2022, and it's called bonus depreciation. Okay. Bonus depreciation allowed you to take a 5-year property, so carpet, cabinets, air conditioner, hot water heater, things like that, and take the full amount in 1 year by doing bonus depreciation. Well, what happened is you could take, let's say you spent $5,000 on the AC unit. You could take the full 5,000. When 2023, that went to 80%, 24, it went to 60, and 25, it's going to be 40%, or in 26, it's 20%. That's a little bit different than this concept, which we were touching on earlier, called a Section 179 expense. A 179 expense allows you to take full depreciation all in 1 year, but then you don't get anything for the remainder of the life. Okay. So if you have a 5-year property that you take all of the expense in 1 year, and there could be tax advantages or reasons that you may want to do that. Let's say you're trying to offset some other income, you had some higher income, you had fewer other expenses, and I really need some expenses because I made more than I thought I was going to. So you're trying to you're trying to take some depreciation, so you're reducing that income, still showing a profit, not a hobby, but still showing a profit, but we were going to show too much profit. So we're trying to take in some of that, and we have 5-year property, but the intent would be we would have it in the business for 5 years, because in years 2, 3, 4, and 5, I don't get anything for that piece. Okay. If I sell it in the second year and I go replace it, well, then I'm recapturing back the 3 years of unused depreciation. So I could wind up with a capital gain. Again, this is the whole concept of tax planning. And I've got so many clients that they own these rental properties. They own a small business. I had a client in another state, I'm not going to say where, but in another state, and they owned an auto repair store. Okay. He rented his building, he owned his furniture, and he owned all of his equipment. Guess how much depreciation he had shown on his balance sheet?
Did he do the 127?
Well, 179.
I'm sorry, 179, yes.
Yeah, he had done a 179 for everything whenever he bought it. So he had no depreciation. But here's the other thing. He didn't have it even on his balance sheet. He had no idea what equipment he even owned.
Oh, wow.
And he had about, I don't know, 70, 80, $100,000 worth of equipment that should have been on his balance sheet. So if he had tried to sell the business, or God forbid something happened and his wife had tried to sell the business, they had no idea what the value of the business is, because there's all this equipment over here
Right.
that wasn't even showing.
Oh.
So what we had to do is go back and fix all of the depreciation, because he wasn't allowed to take 179 on everything. He could on some of it, but not everything. So we had to go back and fix that. And we did it all in 1 year. And it took, me as the guy who did it, it literally took 10, 12 hours to fix this thing, and so it's not cheap to do it.
Sure.
But this is what happens when you just don't know. And so what I always tell people, make sure you got a good accountant, make sure you have a good advisor, make sure you're getting good sound advice in whatever it is that you're doing, and make sure that you're understanding how to count this depreciation. Because it could be that from a tax planning standpoint, you wind up doing everything exactly the way you thought, but then you get into an audit situation and you just sort of did it wrong, and IRS could wind up throwing everything out because you didn't do it the right way. So again, 30,000 foot on this topic. We will dive in future episodes, RJ, and we'll get way into the details, especially on this rental real estate, because we just barely scratched the surface.
Yeah, there's a lot to that. I know.
But when you owned the property, did you? I'm hoping that your accountant talked to you about all these sorts of things.
Oh yeah, we had
Okay,
long
good.
conversations. He was very good about everything. So yeah, I mean, we depend on him a lot.
Yeah.
I do, because I know that's not a strength. And now that
Mm-hmm.
I've been working with a side business, and now it's my full-time business. So we've been with him for, over 20 years. So
That's great.
Yeah.
That's great.
And he's good. He touches base with us occasionally. And now that he knows that I'm on my own, he will, have me come in and talk and go over things on a quarterly basis.
Well, you touch on something, and this is something my partner and Andy and I talk about, is I think it's very, very important when you have any sort of income tax, thing, maybe other than just, a couple of W-2s and some mortgage interest.
Mm-hmm.
But make sure you're sitting down with your advisor in the fourth quarter of the year and doing what we call a tax planning meeting.
Right.
It's important to know what your investments are doing, what your performance is, things like that. But it's also equally important to know what can you do from a tax standpoint before the end of the year, because when you get past the year, a lot of your options go away.
Sure.
And so it's always good to know, what do I need to do? You asked me a minute ago before we started this episode about like microphones and equipment and things of that nature. And I told you, I said, well, in my example, I said, let's say you go spend $3,000 on audio equipment. Do you write off the $3,000 all in 1 year under a Section 179? You could, based on all the rules. But is it the most appropriate thing for you to do?
Right.
Do you need depreciation over time, or do you need it all in 1 year? And that's where, do you want to count the bonus of 40% and then carry over the 60% to remain? That's where tax planning comes in, and it's very individualized. It's very important that you're looking at all these different aspects, because you just don't know. And what you do in 1 year may be different than the decision you do in the next year.
Sure.
And it's all based off of your facts and circumstances in that particular year. So that's what I wanted to cover on the 30,000 foot depreciation discussion.
I didn't get any air sickness or anything like that, but
that's good.
No,
that's good.
There was a lot of great information in there, Jim. How about some contact information?
Yeah. So contact information for us, my direct phone number or text is 205-510-9074. You can reach me on our website, www.cmcfp.com. We're on all the social media channels, whether it be Facebook, Instagram, LinkedIn, or follow us on our YouTube.
Excellent. Thank you, Jim. And most importantly, thank you for listening to the Financial Puzzle Playbook podcast. We ask you to share this podcast, rate it, and leave a review, because this actually helps others find the show. Again, thank you for listening. And for everyone at the Financial Puzzle Playbook, I'm RJ Malik, and we'll see you at the next podcast.